Hey everyone! The commercial real estate market has recently faced two significant headwinds. One headwind looks like it may be abating, while the other looks pretty persistent. To start, jobs. Between June last year and February this year, the employment market was basically teetering on the edge. In net, over those 9 months, the US economy lost 62,000 jobs. But we just got a new employment report, and in May, 172,000 jobs were created, while the totals for March and April were revised upward. That takes the total job count so far in 2026 to 569,000. That's a big improvement from where we've been. If you look at the trailing 3-month moving average, the most recent data demonstrates a significant break from the past several months. Now, most of the jobs created so far this year have been in the service-related industries, dominated by the healthcare sector. But last month, we also got a nice bump from leisure and hospitality. And so far this year, small companies with less than 20 employees have dominated the hiring. But we're also seeing a strengthening in the large company component, with businesses that have 500 or more employees generating the second most positions. The companies in between, with 20 to 499 employees, have basically been treading water over the last year. Now, the forces supporting the job creation may be twofold. First, companies may be adapting to the effects of the tariffs, with many adjusting their prices to realign with the higher cost structures. In addition, most of the job additions have been in the service sector, which has been less impacted by tariffs. But these companies are still facing higher costs, and many businesses have begun to pass those increases on to customers. A second trend potentially supporting increased hiring could be the seasoned available talent pool created by the job losses of the last year. These experienced workers may be particularly appealing to small companies. But regardless of the cause, the job market momentum shift, if it holds, is welcome news for all types of commercial real estate. New job creation bolsters housing demand, it spurs relocations supporting self-storage needs, it can create demand for office space, and boost spending, reinforcing the hospitality, retail, and industrial sectors. So, while the hiring trend is good news, we also just received the new inflation metrics for May. And that's a bit more challenging, with headline inflation climbing 4.2% on a year-over-year basis. And of course, the key inflation component is the price of energy, most notably oil, gas, and diesel prices. Energy inflation is up by 23% year over year. Transportation costs are also up significantly by 8.9% compared to last year, and those cost increases are making their way through to consumers. So while job creation is gaining ground, wage growth has tapered to 3.4%, falling below inflation. If that trend holds, it could ultimately begin to restrain consumption. And the combination of strengthened hiring and elevated inflation puts the Federal Reserve in a tough spot. The improving employment market puts less pressure on the Fed to lower rates, but the higher inflation adds pressure on the Fed to raise rates. Now, it's unlikely the Fed will move rates at their meeting this week. It's more likely that they'll continue to hold rates flat, with any movement likely coming late in the year. So, for real estate investors, the reinvigorated hiring is good news, but the inflation and interest rate outlook are a bit less positive. The combination suggests interest rates will be range-bound, with the 10-year remaining near 4.5%, barring a new significant financial or economic disruption. The bump up in rates over the last quarter could temporarily widen the commercial real estate bid-ask spread, but the market pricing should calibrate to the new rate climate relatively quickly. And we have to remember that the inflation headwinds are likely temporary. Once oil begins to flow through the Strait of Hormuz, the pressures should begin to abate. And at that point, The short-term headwinds should give way to longer-term drivers that support the commercial real estate outlook. That turning point will likely be key for investors who keep their eyes on the horizon.